Money Guide Pro, and we're going to look into asset allocation and how we use that feature here in our Money Guide Pro software. Again, I always like to start with the My Plans area up here. This gets you into home base. Once we're there, when we want to create an asset allocation plan specifically, we're going to go into add a new plan called asset allocation plan. If we want to name it, we could. If we want to name it, let's just call it retirement funds. Let's just use that for now. And then we want to do something called a full allocation is what you want to check down there. Simply click Next. And then it asks us which one of our holdings do we want to look at. Well, I'd like to look at the IRA in Heather's name, and the other retirement account here is the Google 401k. So let's just look at those two investments. From there we click on, after we've checked those boxes, we check on the risk assessment link to the left. We see the Finametrica scores between 57 and 85. Let's pick one in the middle, somewhere around 70. Now that's a very aggressive risk propensity there. Take a look at this. They have $775,000 in those plans, and if the Great Recession hit again the same way it did before, they would be subject to about a 33% or 1/3 loss. Their portfolio is approximately 72% in stocks and 26% in bonds with a little bit of cash. That'll give you an idea of where they stand right now. Then you go down and hit Done, and from there you can look at some more results. You can look at your current portfolio and see how it's allocated. Now this portfolio is 6.94% expected long-term rate of return, but this one's got less stock in it. It's got 57% stock, so during the Great Recession, if that were to occur again, you'll see a 22% loss there. Another big down market was a bad bond market. Well, during that horrible bond market back in the late 1979, 1980, the portfolio actually gained 5%. That's because the stocks did pretty well during that time. This chart here shows viewing your assets by asset class. You'll see the percentages in each one of these. You could also view your assets by the tax category. Now, in this case, they're all going to be in the same tax class because these are all IRA money. But if you looked at these two accounts and how the money happened to be divided, you would see how each one was subdivided there by asset classes. You can look at the target band, and this is based on how you answered your questions on Finametrica. Target portfolio has about 72% in stock, 26 in bonds. That's what we looked at based on your answers from the Finametrica. The current portfolio is the one we just looked at. That's about 57.43 is the percentage there. What you'll notice, the big difference in the portfolio is the projected returns, currently 6.94. The projected long-term return of this total return 2 is the portfolio based on the answers to your questions is a little higher return. You'll also notice a greater standard deviation, 12.6 versus 16.2. Standard deviation measures the volatility of the portfolio. So in order to try and get those higher rates of return, you're going to likely have higher volatility. A comparison on these results, or on how the money should be allocated, you'll see an increase or decrease in the different asset classes. So if you were to reallocate your portfolio and used only the answers from your Finametrica Risk Profile questionnaire, you would make the following changes there. You can see where you'd add some money in some of the asset classes and you subtract some from some of the others to change your pie allocation, if you would, from here over to here, you'll see the difference. Now, in doing so, the projected total return's higher, but if we had something happen like the Great Recession again, you actually potentially lose more money. What the Monte Carlo shows is a number of trials with this different mix. And what it shows in this picture here is they run 1,000 different scenarios with different returns in each one. And it shows a best case, average case, and worst case on how this $775,000 may grow over time. You'll see that the best case is better in the future value of the total return too, because it has more stocks on it. It has a higher expected long-term return. However, as you saw earlier, it also has more volatility in the short run. And this is a graphic picture showing the same thing. So one best scenario out of those 1,000 was way up here. It looks like the second best was pretty similar or to kind of where they were in here. And they look at all the different things here. You could look under years of accumulation and change this. You could change the tax rate also, and that would impact your taxable investments. But that's just a snapshot of what you can do if you want to run portfolio asset allocation between how you're currently allocated and, based on your answers on the Finametrica questions, how you should be allocated if you follow those as your main guideline. I use those Finametric answers as only one of the tools to actually come up with my specific recommendations. Obviously, each one of those asset allocation models has to be in sync with specific goals and their time horizons. So that's only one of the areas that I generally look into. So that's all for asset allocation. Please tune back in for our next presentation.